we're constructive on Asia's macro prospect for both this year and for the years ahead. In the near term, inventory normalization of electronic products and the demand for AI chips are expected to support a moderate recovery of the technology cycle in Asia. Cyclical growth will pick up among the electronic exporters in Asia, while the ongoing structural tailwinds from electronic supply chain diversification continue to support fixed capital formation in countries, particularly in ASEAN. For the other economies, resilient domestic demand will continue to support relatively high growth rates. According to IMF, Asian countries will contribute approximately 62% of global growth this year. Moreover, unlike many OECD countries where core inflation remains stickily high, these inflationary trends in Asia will continue into 2024, with core inflation momentum remaining subdued for most countries in Asia. Therefore, benign growth and inflation dynamics this year provides a solid macro backdrop for Asian fixed income assets to outperform this year. Looking beyond the near term, we concur with the World Bank, which expects Asian economies to experience the highest productivity and potential growth for this decade. We've observed a tremendous sovereign rating upgrade in this region over the past 20 years, with typical examples of Indonesia, Philippines, Vietnam, and India. We expect such a trend to continue for the next decade. As a result, we expect a virtuous cycle to be kick-start in this region, which will eventually lead to significant reprice of fixed income assets, including lower FX volatility, tighter spreads, and lower correlation with other markets. Therefore, we believe Asian fixed income market not only is positioned for outperformance this year, but also there to provide decent and diversified potential returns for investors in the years to come. Unlike some other emerging market regions such as LATAM and some major developed economies, Asian central banks have pursued a much less aggressive rate hiking cycle during the post-pandemic inflation spike. Instead, Asian countries deployed multiple policy tools to mitigate inflation shock, such as FX reserve intervention, capital flow measures, supply-side policies, as well as quasi-fiscal subsidies to smooth the energy shock. Overall, Asia's inflation surprises constantly undershot other regions, and many Asian countries have reached their inflation targets much earlier. As a result, Asian central banks will also ease much less than other developed markets, particularly with more resilient growth. Against this backdrop, Asian bonds will enjoy more favorable yield differentials versus the DM bonds this year, and therefore attract capital inflows into Asian local bonds, which underpins further potential outperformance when the U.S. Fed Reserve starts to cut. In our base case, we expect the first Fed cut to be in July. As for Asian credit, while it has outperformed year to date, the total yield remains quite attractive versus other credit markets. For example, by end of February, JACI was still yielding at 6.4% versus 5.5% of July, which is the US investment grade index, and 3.8% of European IG index. Given its low volatility nature underpinned by very strong technicals, Asian credit will continue to provide stable carry to investors. In fact, one of the key reasons that distinguish Asian credits from other credit markets is our credit cycle. Majority of Asian credit sectors are currently in the sweet spot part of the credit cycle, i.e. repair and recovery, such as Macau gaming, Indonesia industry, China manufacturing, China technology, India infrastructure, where issuers have a right-sized business, improving margins and decreasing leverage. Even for sectors that are in the expansion cycle, such as Indian utilities and Indian cyclicals, strong capital structure and balance sheets with solid sponsorship mitigate excess capex and releverage risks. There are only a few sectors, such as China real estate and Hong Kong real estate, which are still in the down cycle. but better liquidity support and availability in both markets with a supportive policy stance can mitigate default risk in those sectors. This is critical in investing in credit because being in the sweet spot of the credit cycle means less credit rating downgrade risk with limited default risk. Therefore, investors investing in Asia credit could truly enjoy the carry. While bearish sentiments towards China remains high, as a fixed income investor, we beg to differ. Since last year after China reopened from the pandemic, it has become quite clear to us that the Chinese leadership has clearly made up their minds to move away from the old growth model, which relies excessively on borrowing and channeling excess savings into unproductive investment to boost GDP, towards a new, higher quality growth model. This is the core foundation that guides China's policymaking from now and into the foreseeable future. The good news is, China has enough policy tools to provide a floor to economic growth and buy time for this transition period. The not so good news is this ambition of multifaceted, high-quality power building coupled with structural challenges and a seemingly unreconcilable paradox in the long-term goals versus the short-term issues will likely constrain the magnitude and the effectiveness of most conventional economic policies. With the long-term priorities in mind, this period of unexciting macro situation can be best exploited within fixed income asset class, particularly for investors in search of real portfolio diversification and superior alpha opportunities. We believe China government bonds are still in the middle of a structural bull market. China investment grade will continue to deliver stable and competitive risk-adjusted return thanks to strong fundamentals and technicals. And we also see attractive credit alpha opportunities in the China high-yield space, which can be exploited with bottom-up credit research. Real estate crisis is not unique to China. But China's current real estate crisis has its unique features. China's real estate crisis is manifested primarily through the unique pre-sale system in the country and subsequently triggered by the loss of confidence on the credibility of developers to deliver pre-sold units after some of the largest developers in the country went belly up over the past 2 years. As a result, demand-side policies such as lifting home purchase restrictions across cities and mortgage relaxations will only have limited effectiveness unless the issue around developers' credibility can be addressed and buyers' confidence can be restored. Coincidentally, this pre-sale crisis is further compounded by the fact that China's real estate market is due for a structural adjustment. We believe the primary property market will continue the downward adjustment for a few more quarters before it reaches the new equilibrium sales level for the next 3 to 5 years. This explains why liquidity support to developers, particularly privately owned developers, is crucial in reviving the primary market. Since the Politburo meeting in July 2023, we have seen the turning point in policy with a commitment to provide liquidity support to developers to complete and deliver unfinished projects. Such measures should help alleviate liquidity crunch developers have been suffering and buy time for developers to go through the down cycle and rebalance supply and demand once excess inventories are cleaned up. In all, we believe privately owned developers that are still standing have weathered through the worst ever credit down cycle and should come out much stronger over time in terms of operations, brand name, market share, and financial healthiness. But of course, such developers are the minority. Therefore, relentless bottom-up credit research and a disciplined investment process will now be the key to identifying and capturing such opportunities. We like Asian credit as a whole due to the sweet spot credit cycle and as a default cycle is coming to an end. For investors who want to have stable carry or income, Asian credit may continue to provide stable and competitive carry. Specifically, we're constructive on Asian high-yield market that is still yielding at double digit despite year-to-date outperformance. We think it is time for investors to pocket that yield as the default cycle is coming to an end. We believe an investment strategy to build the core positions in the portfolio with the corporates and the financial institutions which are in the repair and recovery cycles may provide decent carry and minimal default risk. And on top of that, taking advantage of market dislocations in China high yield for alpha opportunities may help enhance return. That said, such alpha opportunities can only be captured with relentless bottom-up credit research and a disciplined investment process. Gone are the days when credit research was based on headlines and market chatters. Meanwhile, to capture such credit opportunities requires portfolio managers to have the mentality of underwriting to maturity, particularly given liquidity constraints in any high-yield market.